Here we go. Chinese internet stocks are hot, as you hear a lot about on the show, delivering solid earnings report, but there are some risks that I want to point out. So first, real quick, let's go over some positives. 32% of the population in China is online as of June 2010. That's according to S&P Equity Research Services. Internet usage is also moving to smartphones. Sony said China could have 800 million smartphone users by 2015 as the Chinese population gets even wealthier, and there are almost 900 million cell phone users in general in the country. So huge growth potential. And the thing is, U.S. companies for the most part are not really allowed to operate in China, leaving room for a monopoly by these Chinese companies. Okay, good stuff. Let's go to the negatives here. Operating in China is hard. Lots of oversight and kind of bullying, if I can use that word, by the Chinese government. Big risk factor that a lot of analysts don't think are actually priced into stock valuations. And the markets have recently re-rated these stocks. I mean, Baidu is up almost 49% year-to-date. Revenues did grow 88% in the first quarter year-over-year, but the competition is huge, begging the question, how much more upside is there? Now, Goldman Sachs thinks that the first quarter might have been the last quarter of this huge year-over-year margin growth, which was almost 80%. And Sina up 88.5% year-to-date. Huge run. The real challenge here is, though, that Sina has to go from being a Chinese Twitter company to a social networking site. And Goldman Sachs says as a social networking site, Weibo, which is the Twitter equivalent, is worth about $7.5 billion. As a social media platform, only $1.8 billion. Huge gap there. So Goldman's valuation is somewhere between at around $3.5 billion. Now, some experts say that smaller internet companies like Sina have such huge valuations, trading at 66.35 times EBITDA, that Baidu just needs to have even more valuation right now at about 43.5 times. Now, Scott Kessler, Senior Director of S&P Equity Research, thinks that these valuations are way overdone here. For example, saying that in 3 years, Baidu can grow earnings around 60% on average, but the stock is trading above that multiple right now, and there's a lack of diversification. Kessler's worried that China doesn't have the associated spending in terms of ads and search and e-commerce that the U.S. does, and the competition is way too hot, making it hard for companies to actually grow and diversify intelligently. Takeaway? Some estimates say there could be about 4 more years of growth in the Chinese tech space, so definitely more opportunity, but there is no need to pay up. And we will be